understandably, we've spent a great deal of time and effort focusing on the role of governments. Governments play a significant role globally in terms of their actual material actions. They spend a lot of money doing a lot of things. They also, of course, spend a great deal of time regulating or providing an opportunity, an enabling capacity in a mixed economy, and most of the world is operating with mixed economies, though there's some very, very big exceptions, enabling industry to do various things as well. And I think that what we've seen over the last decade is fascinating when you look at the industry side of the equation in terms of tackling climate change. It's just there are 5 new drivers which have reset the way in which industry writ large has responded to climate change. Even up to a decade ago, you predominantly would have to say that there was a great deal of opposition to any sort of significant action on climate change. That opposition is still there, but depending on which sector you look at, you have very different sorts of results. So we've talked so far about hope and despair with a great deal of emphasis on hope. In this session, I think we're going to have another emphasis. It's going to be on risk and opportunity with a great deal of emphasis on opportunity. And I think the change in the drivers of change have been partly conventional ones in a capitalist economy, risk and profit making, in other words, dealing with shareholders and protecting their interests in a world that is now being transformed by climate change. There's been a shift in social license, and a great deal of public activism has brought the issue of climate change into the realm of industry activity. There's also been the recognition that there is opportunity, and Ross Garnaut really emphasised this. There is actually commercial opportunity, so there's a dollar to be made, capitalism being what it is, the way in which it works, and this is a gleam in many people's eyes now. And lastly, and I think very importantly, there's generational change. And I think that over the last 10 years, we've seen a new generation of leaders coming through, and dare I say it also, a gender shift in leadership, which has really altered to some extent the tenor of discussion at the highest levels of many important corporations, which is then flowing through to industries and economic sectors overall. To moderate this discussion, we have Ben Neville, who's an Associate Professor in the Department of Management and Marketing, Faculty of Business and Economics at this university. Ben researches and teaches in sustainable business and society, including corporate social responsibility, business ethics, ethical consumption, and social entrepreneurship. He also serves at this university as the Gourlay Fellow of Ethics in Business and the Sustainability and Curriculum Fellow for the Faculty of Business and Economics. He's the coordinator of governance, policy, and market streams in the Master of Environment, chair of the university's Fair Trade Steering Committee, and sits on the executive committee of the Melbourne Sustainable Societies Institute. Well, currently, used to, is now, of course, the deputy director of MCF.
Thank you very much, Peter, for that very warm introduction, and wonderful to see everybody here in this room. I thought I might just mention there's a lot of people at that end of the room. If you feel, hi there, everyone. If you are feeling like you're a bit squashed up there and you're sort of having to look at the screen, there are quite a few seats up here. Please feel more than welcome to move over here, and if that might be a little bit more comfortable for you. So as Peter mentioned, in this panel, we're going to be looking at business and investment. And what we really want to be doing is opening up the doors of the boardrooms and the executive suites of Australian private corporations to really get an understanding of some of the decision making that goes on, some of the big decisions that allocate resources that have such an important impact and have arguably been the main driver that has got us into this climate emergency. But also, I would suggest, is where the big decisions really have to be made in terms of getting us out of the situation that we're in. When we talk about policy, when we talk about activism, when we talk about litigation, it's all about trying to influence those decisions that get made in those rooms. And so the panel that we have today will be fantastic in terms of helping open those doors and giving us some insights. Certainly, I think we should all be aware that corporate Australia has moved much more positively, especially in the last few years. I think, especially in that last period of the last federal government, they especially moved, and probably because of the lack of movement of that federal government. I think if we see the Business Council of Australia as indicative of the position of corporate Australia, at the very last election, they were very supportive of Labor's policies because basically they were the policies of the Business Council of Australia, supporting the safeguard mechanism. But there was a very important point at one stage in that election when the then federal government started to try and introduce a very sort of toxic position in terms of climate, and it was shut down very quickly within a couple of hours by the BCA. I thought it was a very important contribution to that election campaign. But the election before that, back in 2019, the Business Council had the opposite position and were supportive of the 26 to 28% targets of the then federal government, and claimed that the opposition's policies would be economy wrecking. They then had targets of 45%. Of course, they've come in at 43% now. So I think that shows very clearly the way that corporate Australia has really moved forward now. So we have a panel, and Peter mentioned about gender in this space. We have 2 women on the panel here, and we have 1 other woman online, hopefully joining us. And you know, in my work in sustainable business, it's very often dominated by women, absolutely. So remind you again to use the QR codes and Slido to put forward any questions you might like to ask the panel. I'll be firstly just introducing them one at a time and asking them a question, and you know, so they will have 5 minutes or so to each respond to that question, and then we'll go to questions from the audience. So please hop in and ask away. I firstly would like to introduce Zoe Whitton, who is Head of Impact at Pollination Group, which is a specialist climate change investment and advisory firm. Zoe has worked with big investors and large companies for the last decade, helping them to work out their responses to climate change. Previously, she had similar roles at Credit Suisse, Bank of America, and Merrill Lynch. She also sits on a number of climate-focused industry boards, including the Investor Group on Climate Change and Centre for Policy Development. So Zoe, you work with both large investors and the companies they invest in. What can you tell us about how investors are now recognising and integrating climate risks into their decision-making and activities, and what influence that is having on their responses to climate change?
I don't know if this is on. It's on. I have a bad record with microphones. So this one just seems to know what I want, and it's doing it. I was glad. I was worried as we were coming into the entry comments that there was commentary about having focused more on hope in the earlier panel, and I was worried that someone was going to say we're going to be focused on despair in this panel, which you could be forgiven for thinking that was the direction we were going in when we start talking about investors and corporates. But I wanted to pick up some of the comments of the previous panel in answering that question, particularly this point that we are coming into, or we are in the implementation stage now. And I would tell a story to illustrate that. I remember coming back from COP15 too long ago now, and everyone feeling a bit torched emotionally by that experience. And BZE released their first report. I think they, from memory, the BZE report came just after coming back from COP15. And the BZE report, for those of you who remember it, sort of said, this is the technical answer for how we do the transition in Australia, and we can do it, and it's possible. And it was a very engineering heavy, very technical report. And I remember looking at that and we all went, amazing. Like, you know, sock it to you, people in Copenhagen who didn't want to make agreements about things. We're going to do it. And it felt like that was the answer, and great. We kind of overcome the big technical barrier. I would say the experience of my life between here and there has been that was the first step, and the second, or the ongoing 99 steps after that, are about making that idea real in social and technical systems that certainly at that point in my life were much more extensive than I had an understanding of, and also are much more boring, tiring, and endless. But that is the work that we're in now. We're in that is anything that is important becomes political, and we are well and truly in that stage where we're in implementation and it is political. And that means that we're building a lot of social and economic infrastructure around this problem. It sometimes seems really detailed and, terribly boring, but is hugely important for taking the view of where we wanted to go and turning it into something we actually did. So to the question of, how are we seeing investors engage with the world on this topic, we've obviously seen just an extraordinary uptake in interest and the thought process on climate change in the investor, and I should say capital markets universe more broadly. There are a slew of acronyms which don't quite rival the number of acronyms that bang around in the policy space, but still have a lot of CCCs in them and CCs and various other bits and pieces. But they all describe this sort of explosion of industry action around setting norms, setting directions, setting ambitions to try and go through transition in the investor space. And that's been hugely important, not only because it's got us over, and it has also represented a getting over of the idea that this was a huge cost. Corporate sector was going to have to bear it. There wouldn't be any good outcomes. And anyway, worrying about sustainability is not something that corporates need to do or investors need to do. That's gone. And that's amazing, because 10 years ago when we started in this, that wasn't gone. That was still the dominant narrative that we would hear when we faced into those audiences. But what that has meant, and what it is meaning, is that we're seeing a new role emerging for investors and a new role for commerce more broadly. There's a much less contentious than it used to be view now that the corporate sector and investors do not only have a set of risks to manage, but also have a set of responsibilities. And you mentioned opportunity, and I think that's a really important one, because a lot of people are rapidly going, oh, wow, decarbonising the whole economy means you've got to change the whole thing. Oh, that might mean we need new products and services. Wow. Immediate interest. But there's also a much stronger acceptance of the norm that whole sector of activity has some responsibility to respond to this problem, and that all of the things that sector wants to do won't be doable in 50 or 100 years if that response isn't sufficient and sufficiently rapid. So we're seeing that interest for investors pushing through directly into companies. I'm sure we'll talk about regulators as well. But what it's creating is this reinforcing environment that a lot of corporates now find themselves in, where you've got your capital providers asking for this, but your capital providers are also asking your suppliers and your customers for it. So your suppliers and your customers are asking you for it as well. So we've got this great, at the moment, and not perfect, but very, very new and different reinforcing cycle that we're starting to see in the corporate space and in the investor space, which is driving a huge amount of action. And there's a lot of controversy about how. And you see a huge amount of debates about, what are the right risk metrics to demonstrate the outcome of stress tests in banks under physical scenarios, or what is the appropriate way to take the standards of the ISSB and put them into global circulation as rapidly as without confusing everyone, and how much protection do we need from those standards and the like. Heaps of debate around the how, but we are going to have decades of that debate around the how, because that's the stage of the conversation we're in at the moment. And just to make a comment on the Hope budget, I was reflecting on Zeb's answer and thinking that my answer would be across a similar time frame. I walked out of COP15 thinking I'm not going to work in policy, I'm going to work in finance, because every answer that we had that was no came from finance at COP15. COP26, I decided not to go because there were 28,000 people going from finance, including about 15 people in my firm. And they were all well and truly convinced that they needed to be there, and it was a central part of the conversation. Oh my God, what are we going to do? We take that for granted now, but that is such an extraordinary change over quite a short amount of time. And I think it is a really good example that this is becoming political, because it is important and we are going into the implementation stage, but we're also seeing really, surprisingly excellent outcomes in that implementation stage, even though we're, not going anywhere near as fast as we need to and still in disastrous danger and all that stuff.
Yeah, brilliantly put, Zoe. Thank you very much. I'd now like to introduce Karina Gistelinck, who is online. So Karina is BHP's Vice President for Strategy and Market Intelligence, and previously had roles in other miners, Rio Tinto and Vale. And before that, she worked with global consulting firm McKinsey and large American law firm Cleary, Gottlieb, Steen and Hamilton. Now, Karina, you bring knowledge and experience working on strategy with large multinationals and now directly with big global miners, including with companies transitioning out of fossil fuels. But it's your industry. Is your industry really serious about responding to the climate threat?
Thanks, Ben, and really privileged and humbled to be in this very amazing panel. And just to add to a bit of comment on sort of that fifth driver on diversity, I would like to call out that the shift I've seen in the resource industry is not just around gender diversity, but also a real shift in all types of diversity, background, nationalities. When I joined the mining industry, it was a predominantly male Anglo-American engineer world, and I certainly see now a lot more females, but also a lot more people from different backgrounds, from developing countries, social scientists, media scientists, even joining the resource industry, which I think reflects a bit of that change and the change for the better. And look, on the theme of hope and despair, and as a chief strategy, I like to say that hope is not a strategy, and certainly despair is not a strategy. And what I've seen over the last couple of years in the resource industry is not just a commitment and not just sort of a ambition to, make climate change business as usual in the way we do business, but more importantly, to really lead the debate and not just lead with words, but lead with action, really. And so if I was to summarize what I've seen and how the resource sector is looking at this, I would summarize it around, taking a very proactive stance to lead with action. And I think we've all seen, big commitments being made by the major mining companies. It's a bit of a race to the top now, and not a race to the bottom, which is great, and it's a really big change from where we were sort of 10 years ago. So everyone is putting forward commitments on scope 1, scope 2 emissions, and also on scope 3. And if I look at sort of what we are doing at BHP, I think I would like to call out 5 big things that we're really doing to show that, this is not just, words, but really leading with action. The first one is we've made ourselves our midterm target to reduce our own operational greenhouse emissions by at least 30% from where we were at in 2020, and this by 2030. And it may seem a long time for folks here, but really within the mining industry, 10 years, a decade is a heartbeat, really. And a net zero goal for these, scope 1 and scope 2 emissions by 2050. If we look beyond that, scope 3 commitments, and for me, that's probably the most sort of fundamental ones, because the scope 1 and scope 2 part of the overall emissions is just a tiny bit, right? So it's really about these 3 scope 3 emissions where we can move the dial for the world. Again, you've seen commitments from the entire industry. In BHP, we have committed to a net zero goal in 2050. We have 2050 targets for our maritime, so the logistics business, and for our procurement, which is to really decarbonize our entire inbound value chain. And we have already made taken actions to also decarbonize the value chains we sell into. The predominant one obviously being the steel one, which, as we all know, is a hard to abate one. So we have partnerships with customers. We're investing in innovation and in technology to enable and to crack the code, really, on how to make steel in a more sustainable and greener way. We have a ventures pipeline with very exciting sort of early stage options there to help us together with our partners decarbonize that. The third thing we're really doing to show sort of, that this is real and that we're trying to lead with action, we're also putting our money where our own individual money where our word is, and we're linking increasingly climate change performance to executive remuneration. not just to send a signal, but to make sure that, you know, executives focus not just on production and cost and getting the stuff out of the ground and into our terminal markets, but also are really focused on these longer term goals. And they are longer term. So it is a challenge on how you do that linkage between climate change performance and executive remuneration, because it's not something that you can track, you know, on a monthly basis. But we have done significant changes there. We have 10% of our current cash and deferred plan scorecard based on solely on climate change performance. And in our long-term incentive plans, we also link this to a total shareholder return. So I think that's, again, a sign that this is for real. A fourth thing that we do is, and Zoe spoke a bit about the, not just the risks, but the opportunities. We have assessed and we continuously assess our portfolio against the 1.5 degree scenario. And some of the portfolio decisions that BHP has made over the last years, and you've seen our exit from the petroleum business, you've seen also exit from certain of our met coal assets, and the pivot towards sort of the more what we call the future-facing commodities, copper, nickel, but also potash, are based on that assessment against the 1.5 degree scenario. So I certainly believe, actually, for the resource industry, climate change is not doomy and gloomy. It's full of opportunities. You just have to put in a different lens and look at, you know, what the world will need to decarbonize. It's still very much, you know, focused around resources. Yes, there is a shift away from fossil fuels and from sort of more carbon footprint heavy resources, but there is a magnificent upside in what other resources are needed. And you no doubt have seen the race for the lithium mines and the nickel mines, but also copper, and even less exotic sort of commodities such as manganese and some of the rare earth are really needed for the world to decarbonize. So I certainly see a lot of opportunities, and part of my job is to constantly do that assessment and look for these opportunities. Of course, address the risks as well and be transparent around the risks, but also focus on what new business this can bring, and how as a resource company you can help the world solve that problem that is resource availability for that decarbonized and electrified world. And the last thing that I would like to highlight, which I'm personally very proud of, that we do at BHP, and again, there's a race to the top there. My previous employer, Rio Tinto, has a similar model, and so does Vale and Anglo as well, which is, how do we bring climate change to our management systems, and how do we make it an integral part of how we assess the attractiveness of capital projects, the attractiveness of business opportunities, also the way we value the value created to society. And so we have in place now what we call the social value framework, and it's called social value because it encompasses not just emissions related externalities, but also other considerations around biodiversity, community impacts, and so on. And it's now an integral part of our management systems, very much like the way we run our budget process and the way we run our capital allocation process. We run a social value framework as an overlay to all of the management decisions. And for me, that really shows that we're serious about this, that this is not just something we're doing for the sake of marketing, or for the sake of maintaining our license to operate, but really because we believe this is the right thing to do for a purpose, and it is good business too, and we shouldn't be ashamed of the fact that it is good business, because in the end it's a win-win for society, for resource companies, and for the world.
Thank you very much, Karina, for those insights. And I'm sure many people might have other questions they might like to pose to sort of really drill down into some of those things. Now I'd like to move to Sarah Barker. Now we commented in the last panel about how important litigation and the courts are, and we are very privileged to have one of the Australia's and the world's leaders in this area on our panel. So Sarah Barker leads the climate and sustainability risk governance team in the Asia Pacific's largest commercial law firm, Minter Ellison. She has more than 2 decades experience as a corporate lawyer and is regarded as one of the world's foremost experts on climate change governance, finance and liability risks. So Sarah, how is the law being used to influence corporations?
Thanks, Ben. Sorry, I'm out of practice. I've been in Europe for a month, so if my brain's a bit fuzzy. Thanks for the introduction, making me sound really boring. I actually did want to take everyone down a bit because Peter talked about opportunity in his intro and Zoe talked about opportunity. I don't want any of that crap. Corporate lawyers deal in risk and we deal in money. And that's really in the 5 minutes I've got to talk about litigation in a climate context. I want everyone to start thinking about risk and money, because with the evolution of climate change to be a material, financial risk and opportunity, that's enlivened the entire suite of corporate law to claims where you fail to manage the risks and opportunities, the financial risks and opportunities associated with climate change. So I'm going to talk to you about 3 key areas in which climate litigation is having a significant impact in the corporate sector at the moment, none of which are environment and planning law, none of which involve human rights, although there are significant claims on foot in those areas. So the 3 I wanted to talk to you about: fiduciary duties, directors' duties, so the obligations at the top of the tree in corporations, misleading disclosure in a corporate context, and some French to brighten up our day before lunch, force majeure, which is contract law. And I'm sorry if anyone speaks French because I really have got a shocking French accent. So talking about those, directors' duties and responsibilities. There are cases on foot around the world that suggest that where directors are not proactively managing their businesses, not only to take climate-related risks into account, but failing to drive strategies that are consistent with a 1.5 degree trajectory, that is a breach of their duties to the company as a director. So there's a particularly interesting claim ongoing in the UK, where a public interest law firm called Client Earth has issued a pre-action letter against the board of directors of Shell individually. And they're saying that the board has breached their duties under the Companies Act in the UK, very, very similar to our Corporations Act here in Australia. And they're saying, well, first of all, your failure as a board to ensure that Shell introduces a strategy that is consistent with the Paris Agreement from a strategic point of view, from a monetary point of view, in terms of the best interests of your company to promote its success, that is a breach of your duty to promote the success of the company. And secondly, they're arguing that those directors have breached their duty of due care and diligence by failing to oversee the risk management within the company, by failing to ensure, even in relation to those targets that Shell does have in place to decarbonise, which are alleged to be inadequate in the first instance, even those inadequate targets, management isn't doing enough to put forward plans even to achieve those targets. And that's alleged to be a breach of those directors' duties of due care and diligence. That's number 1. Second category, misleading disclosure. Greenwashing. It's everywhere at the moment, greenwashing. Significant number of cases now in a corporate context alleging that disclosures to the market by companies are misleading or deceptive. On top of that, we've got ASIC looking at all these market disclosures. We've got the ACCC even just this week announcing that it's doing a sweep of everyone's websites to make sure that the promotional statements that they're making are not misleading or deceptive. But in that corporate context, there's a claim on foot, notably in the federal court, where ACCR, the Australasian Centre for Corporate Responsibility, has brought an action against Santos, alleging that Santos's 2020 annual report was misleading or deceptive in the way that they described their decarbonisation target, where they've said we have a clear and credible plan to reach net zero by 2040. And amongst other things, ACCR said, well, that's misleading by omission in what you didn't clarify your target with on 3 grounds. First of all, the board hadn't actually approved the strategy by which they were going to reach the target at the time that that annual report was published, it's alleged. Secondly, by failing to disclose the primary basis on which the company planned to reach that target is carbon capture and storage. And that technology has not been developed commercially to a level that would enable Santos to do that as yet. And thirdly, it's alleged that it was misleading by omitting to clarify that Santos has a business strategy to actually increase its emissions in the near term by continuing to explore and expand its production before then reverting to a downwards trajectory. So on those 3 grounds, and additional grounds like calling gas a clean fuel, it's alleged that that annual report was misleading or deceptive. That remains before the courts. The third category is contract and force majeure. Now, force majeure is pretty bog standard for any corporate lawyer's toolkit. This is the clause that we chuck up the back in any large contract, which is the get out of jail free for unforeseeable acts of God. You know, so if there was a alien to land on the roof of 700 Swanston Street, you know, it would probably mean that Jackie doesn't have to pay the conference centre for the use of this building because it was something that was unforeseeable and not within anyone's control. You can walk away from your contractual obligations. That is becoming a huge issue in a climate context because, of course, the one certainty with climate change is that the future looks nothing like the past. And just because a physical event is unprecedented doesn't mean that it is unforeseeable. And yet corporate lawyers just continue to chuck these boilerplate act of God clauses up the back of contracts, and they don't work anymore because all these unprecedented events that haven't been contemplated by people because they haven't happened before are actually foreseeable. So there's a great case, a really obscure case, but a really, really good one. A single judge of the New York Supreme Court that arose out of those once-in-a-lifetime blizzards that happened in Texas last year. And when these blizzards happened, there was a big wind farm in Texas called Stevens Ranch. They had 216 turbines that stopped spinning. Apparently, turbines don't spin when they got 6 inches of ice on them, which is the extent of my engineering knowledge. So these turbines stopped spinning, which meant that Stevens Ranch couldn't supply electricity under the supply contracts that it had with its customers, like Citigroup. Citi had on-supply obligations to its customers. And so it had to go out in the electricity market in the middle of a blizzard and buy up other sources of electricity so it could comply with its own contractual obligations. And it spent $113 million US extra for 1 day's worth of electricity supply because, of course, very basic supply and demand, electricity is really, really expensive in a blizzard. So Citi turned around and sued Stevens Ranch and said, well, you owe us $113 million because you couldn't supply. And so we had to pay all this extra money. And Stevens Ranch said, oh, no, force majeure. This was a once-in-a-lifetime blizzard. This had never happened before. That was totally out of our control. SOZ. And the court, technical legal term, and the court said, well, no, force majeure does not apply here. This might have been a once in a lifetime. This might have been unprecedented, but it was not unforeseeable. It was overtly, reasonably foreseeable. We have talked about climate change for decades. We have talked about the potential for both extreme hot and extreme cold weather in Texas as a result of climate change, including a specific report on that from FEMA for decades. So it was foreseeable. And secondly, was it within your control? Hell yeah. The blizzard wasn't, but you could have weatherized your turbines. And in fact, many of your competitors did weatherize their turbines as a result of all these warnings about extreme hot and extreme cold and were able to continue to generate. So Stevens Ranch has now been rendered bankrupt as a result of that judgment. So the moral of the story is your corporate lawyers need to know about climate change. It's a bet the company issue. If your lawyers don't know about climate change and can't, when they're drafting contracts on your behalf, make sure that your interests are covered.
Excellent. Thank you very much, Sarah. So wonderful from all the panelists so far. Now we'll move to some questions on the Slido. There's been a number of questions that actually refer to greenwashing, which obviously Sarah referred to in terms of in courts and also with regulators now looking at it. And so some of the questions then become redundant, but one of the questions that's further down the list was around to what extent is this actually having an impact upon corporate culture? And so I think probably to Zoe and Karina. Zoe, what have you observed actually in terms of any changes within corporations that these actions on against greenwashing? Have you seen what sort of focus and concern and changes have you observed?
So I think there's an interesting question there about what changes do you observe broadly and which specifically in respect to greenwashing? Because broadly, there have been some extraordinary changes in corporate behaviour that are found that sort of sit as a foundation to the changes we see on greenwashing, which is 10 years ago, if you were to talk about climate change in most corporates, people would literally immediately put you in the tree hugger box and switch off. And so the types of entities we're talking about in the corporation who have concern to these issues, so Sarah's just talked about directors, were basically asleep at the wheel on this a decade ago, even though we very clearly understood that this was coming and that there was a clear and significant risk. So that's been a massive shift. And actually, for those of us who work in the space, has sometimes been a bit taxing because you've gone from having 2 people in the corporation who wanted to talk to you about it to 100 people who now all desperately need to know about it yesterday in the space of sort of 5 years. And each year that number of people just gets bigger and bigger, to the point David made earlier. Climate change is now a concern for almost all functions in many corporations. So this is sort of this extraordinary change in the way that you countenance this issue and talk to this issue and even give it any legitimate space in corporate conversation. Part of what we're seeing in corporate culture as that happens is an extraordinary change management load, and change management is such a squiffy term. But what I mean there is that when you go from not thinking about this that much at all to thinking that it is relevant for all of your assets, all of your customers, all of your suppliers, all of your directors, and all of your legal responsibilities in the space of about 5 years, you basically have to transform the corporate culture as it relates to the topic extremely rapidly. And that exercise is change management, squiffy term. So a lot of the impacts we see on corporate culture are actually in that space of the corporate having to revise itself constantly and think about, like, reorganize how it relates to this problem. But on greenwashing particularly, we probably have, and Sarah, I have a lot to say about this as well, seen a massive tick up in I think someone said at a conversation we were having the other day, they were like, look, this used to be a thing that the marketing department largely was in charge of, and they would get the information and they were interested in a good story. So they'd sort of spliff it up a bit and expand it and so on and so forth. It is now a material commercial issue, including with the way that you relate not just to your civil stakeholders, but also to your regulators. And so the process you use, for example, to go through your sustainability reporting has transformed almost entirely. And now you're there's the 3rd and 4th and 5th and 6th steps, which includes legal, CFO, legal, which is the process of trying to make sure that everything that is in there is completely bulletproof. And to put a fine point on that, when I started, I've worked in financial markets primarily. When I started, we used to have this conversation. Some of you will be familiar with the term material non-public information, which is information that someone has in a company, but that isn't known to the market. and that if it were to leak into the market would threaten the integrity of the market, because everyone in a market, financial market's meant to have the same amount of information. It's a big part of the principle. When I started, all information related to sustainability and climate change was considered to be non-material. So you could go and have a conversation with a listed company. They could tell you something they never told anyone else about their climate change strategy. And no one in financial markets regulatory universe was really going to care that much about that because it wasn't material. That information is now critically material. And that means that the way that we deal with that information, the way that we relate to it, has just had to transform completely in about 7 years. And that's I think you can imagine the size of the corporate engine that's sitting behind that disclosure now, having to develop that rigor and to understand it as a material set of disclosures rather than just kind of like a little thing that some stakeholders love. I'm going to pause there because I'm sure that the others will have a lot more to say about this, but needless to say, it's been pretty extraordinary shift.
Yeah, thank you. I'm sure the many people that asked questions around greenwashing were very pleased with those insights. Karina, are you able to share any insights with your experience with responding to greenwashing, specifically from BHP or one of the other corporates you've worked with?
Absolutely. And sort of a bit building on what Zoe just mentioned, I think sort of 3 key changes that I've seen in the resource industry that really give me hope that things have changed and will continue to change. So first, a radical shift from sort of ticking the box exercise, we need to do this report, just going through the motions, to a real drive for radical transparency. And beyond sort of the legal risks that Sarah outlined really, really well, I think there's a bigger stake at stake for corporates these days, which is you can't get away with just doing greenwashing and reporting, buggers numbers or making it a marketing story like Zoe did. You can't get away with that anymore. You can't get away with your governments, with your stakeholders, but you can't even get away with your direct customers and with consumers more general. So that real drive for radical transparency and being, honest, realistic on what you report, and also coming up with a plan on how you're going to fix some of the issues that will continue to exist for quite some time. So I think I've seen that really happen, and I think that that change won't go back. It's there to stay. I think sort of another change, and again, Zoe alluded to it. When I joined, sort of there was it's a very small climate change team, and they were the ones responsible for anything and everything related to climate change. Now the shift has been climate change is every single manager's and every single employee's responsibility, really. Very much like the way we, as a manager, we manage people. That doesn't mean that it's HR's responsibility to do the people management. It's my responsibility to manage the people that are in my team. And very much the same with climate change. So a little bit of shift on accountability. There's not just, one group that is responsible for it. That group has expertise and can advise, but ultimately it's the responsibility throughout the organization. Now that doesn't come without risks, because when many people are responsible and accountable for something, the risk exists that nobody is accountable and responsible. So I think there's a bit of work to be done still around that, to avoid indeed that greenwashing that sometimes comes with just, people trying to report different things from their angle, none of which are untrue, but that can perhaps not really reflect the reality. So I've seen a big shift there as well, and again, a change that I think it makes this all for the better. The last thing that I would like to highlight is the change also in approach, which for me again makes greenwashing a lot not less likely to happen, because it is happening, and let's be honest, it's something that we will need to work through, but that will also help combat and fight that sort of malpractice, which is it has sunk to the industry now that we can't solve this individually. That if you want to decarbonize, for instance, the cement value chain or the steel value chain, you need to do that together with partnerships throughout the value chain. And that means you can't not just, push the problem to the next one, right? We say, oh, I cleaned up my scope 1 and scope 2 emission. It's now all about scope 3, because really that won't get you anywhere. Consumers won't buy that anymore. And so that need for doing it collectively within the value chains in partnerships, for me, will also tackle the problem of greenwashing, because you can't sort of just move the monkey to the shoulders of your customers or of your suppliers. You really need to solve this together for the better, and for in a sustainable way. And I think that will also really hopefully help with getting rid of some of the greenwashing practices that are still existing out there.
Thank you so much. Sarah, you're probably often one of the people called on to actually do work on this issue. Have you got anything you would add in terms of corporate responses to greenwashing?
Yes. She said, trying to think of how she's not going to disclose any client confidences. No, but absolutely. I mean, before I've specialised in sustainability for 10 years, but for 15 years before that, I was a misleading disclosure lawyer, which has kind of set me up for this. Initially, I think, as Zoe was saying, it's very much the marketing department. And, there's always a tension with the marketing department. By the time it gets to the lawyers at 1 second to midnight, can you sign off on this? There's always that tension. Their job is to pump things up, and our job is to put a pin in it and make sure that it is, defensible from every angle and not exaggerated. But because climate change has evolved to be material financial risk, the consequences are far more severe. So yes, the marketing department now needs to be doubly careful, but also because it's now in the annual reports, and not just the narrative part of the annual report, the financial statements. It has implications for your statements of asset and liabilities, the balance sheet, for example. The whole process now has to go through legal multiple times. As an example of how material this can be, it's not even a case yet. There's an investigation that is on foot against DWS, which is the asset manager 80% owned by Deutsche Bank. Kind of towards the middle of last year, there was a whistleblower, the former head of sustainability in DWS, who had quit on the basis that she had raised concerns with management that they were promoting to the market that they took ESG issues, sustainability issues into account when they were investing on behalf of their clients. She said, well, it was a little bit exaggerated. We don't do it as robustly as what we might be suggesting, and that concerns me. And when management didn't listen, she quit. She went to the papers. That then sparked an investigation by the Securities and Exchange Commission in the US and BaFin, who's the ASIC equivalent in Germany. And when it broke that this investigation was happening, the DWS share price fell by 13%. And then in June, BaFin did what's called a dawn raid on the offices of DWS, basically where it goes to the office, slaps a warrant down at reception and says, we're allowed to take whatever documents we want that relate to this investigation. The share price fell by another 5.6% and the CEO lost his job. So cumulatively, that's about 19% worth of value lost in a company worth tens of billions of dollars because of an allegation that there was greenwashing in what they do. So this is not something that is just the province of the marketing department anymore. Again, it's a bit the company issue.
Can I add to that the reverberation from that outside DWS, which is the number of conversations that I've had in the 6 months following of people going, can you imagine a dawn raid? Like, is this a Cold War? What are you doing? It's changed people's imagination regarding how significant this is and the sort of trouble they might get into quite significantly. It just keeps coming up again and again.
Yeah, thank you both. I'll move now to the question that was had the most votes, and that refers to offsetting. And maybe, Karina, I'll ask you to respond first. That is, how confident can we be in corporate responses to climate change when so much of the response involves purchasing low-integrity carbon offsets rather than genuine decarbonisation? Karina, do you have any comments on that?
No, great question. and look, I'll comment a bit on sort of the overall industry sort of tendency, and then I'll comment specifically for BHP. And it goes back to a bit of that greenwashing discussion as well. And I certainly see the trend there being a race to the top, not a race to the bottom, but it will take time. And yes, indeed, there has been a flourishing market for carbon credits, and like with all sort of new financial instruments, the quality of it can be very diverse, right? And it's a bit like bonds and equities, right? You have your junk and you have your very high quality ones, and that market is still very immature, and it's still sort of sorting itself out in terms of standards and in terms of how we actually account and what also these offsets are used for. And I certainly believe that with time, we will actually have, again, a race to the top where only the high quality, really, incremental, sustainable, definitive carbon credits will be the sort of the reference in that market. But there's still a way to go before we get there. And I do think there's a major role for private companies to play in this space, in particular with regards to standard settings. How do we measure what is being claimed? How do we track whether what we've bought is really being implemented? Whether that carbon avoidance is real, or whether it's more sort of a marketing story. So there's definitely a role to play. And that being said, I think that will sort itself out with the multiple stakeholders coming to the table to discuss this, and then ultimately supply and demand. I do think that high quality carbon credits, for instance, will command a higher premium because they are worth more, and there will be more demand for that, because in the end it's not about fake reporting, it's about the real impact you want to have. That being said, offset typically in a mining industry where I've worked are sort of a bit of a lender of last resort. We are certainly in BHP, we're looking at permanent solutions to decarbonize our footprint through the process, not to just continue polluting, continue emitting, and then offsetting it financially, but to really change. And to give you a bit of an idea, roughly 80% of our emissions come from either electricity or diesel. And so rather than going in and buying carbon credits to offset that, what we're really trying to solve for is how do we get green energy, and working there with utility providers, with project companies to actually look at alternatives for the electricity in where we operate, to decarbonize that grid, if you want, because we're not going to be in utilities, but we want to be a consumer of green power. How can we do that? And the same with the diesel or bunkers, which are the other big sort of component of our footprint. The idea there is, again, not to continue using fossil fuels and then offset it through credits, but rather really decarbonizing the way we move things around. And so there we work with our suppliers, with the OEM that build the trucks, and with the ship owners who build the ships, to come up with different technologies that do not have that same footprint, so that we decarbonize for real, rather than buying ourselves out of a polluting sort of footprint. So definitely that's that. And again, from prior experience, this is also how other mining houses are looking at it, and really solving the problem, rather than fix up, if you want. With regard to Scope 3 emission, we see the same happening. So we see our customers, for instance, the steel mills, looking for real solutions to the problem, rather than just a band-aid solution. And there's some really interesting debate as to what is a permanent solution. Sarah mentioned earlier on sort of the technology that Santos is betting on, which is carbon capture and storage, or for those initiated, CCS or CCUS. That's certainly one that is, controversial. Is it really a solution to capture and then store it? How long can it be stored? How is it really going to impact, the world and the surrounding environments in the long term? And again, I see a really major role for companies to play in that debate, in a transparent way with society. Okay, we need to come up with a solution that is economic, but that is also really sustainable. And I think that type of debate is the right one to have now, so that we don't create, we don't sort of just masquerade and put lipstick on a pig, but rather solve for the right things with the right economic return, of course.
Zoe, have you got any comments on this?
I do. As many of you know, Pollination does a lot with offsets. There's an interesting thing happening with offsets, actually. So 10 years ago, 15 years ago, when we talked about offsets were often talked about in regulatory systems, so what we call compliance systems, and they were basically a way to make carbon fungible. And the idea was that you would reduce emissions in a place where it was least expensive, and then by an accounting means, overlay, you could move those emissions to someone else so that you could, as a system, go for the fastest stuff first and then do the harder stuff later, while bearing responsibilities across a group of actors rather than just going to two of them and going, you guys go first, don't worry about it, those guys will go soon. So you're trying to share the burden across the group, but go for the easiest options first. Because we haven't had compliance systems and regulatory systems in a lot of regions, offsets in the interim started being used voluntarily. So corporates that wanted to say, we want to make commitments about this, and we've got this idea of offsets. Obviously, it was a big part of Kyoto. That idea came along, corporates went, yes, we can take that, we can do something with it. And the use of offsets for voluntary commitments, I think, has introduced a lot of these quite crunchy questions about how many of them, when is it actually okay? Is that a reasonable thing for you to be doing? If you're thinking about a net zero target within a company, can that really be part of it? And is that meant to be the use of that instrument? And that's where we're there at the moment, where we're having conversations that, like we've just talked about, which are about mitigation hierarchies, saying, look, do everything else first as a voluntary, as a corporate, because you really can't rely on that just being buy your way out of jail. I suspect that norm is going to keep moving. And what we're detecting in the discussion is that we might be going to a conversation that is about net zero now and zero in 2050. And that is to say, pull your emissions down and cover all of your remaining emissions with offsets. And that's because the role of offsets, the other really important role that offsets have is they allow you to fund natural solutions, and they allow you to fund natural solutions in regions and among communities that otherwise don't necessarily have a funding mechanism for this transition and for adaptation as well. So I just flagged that norm is moving quite quickly, and I wouldn't be surprised if we have this conversation in a couple of years that we have reconstituted the role of offsets again. We're starting to turn on some of our policy systems, and some of them are still designed to the way they were 10 years ago. So that's the other thing that we're watching, is whether those policy systems that think of offsets in a certain way and the normative social systems actually come into conflict in ways we might not anticipate.
Yeah, thank you so much, Zoe and Karina. And I might note at this moment that the university's own targets to be carbon neutral by 2025 include buying a lot of offsets. There are many categories that we won't be able to decarbonise by 2025, and so we are very much in the mix in terms of this whole sort of question around how we deal with offsets. And so it's a very live question that we will continue to have to be part of the conversation, both as researchers and convening conversations, but as a very significant player in our own right.
Ben, can I just make a comment on that, because I know we're at time. You used the phrase carbon neutral. There is a difference between carbon neutral and net zero, and offsets is a big part of that. You can't say you're net zero if you're using offsets. You might be able to say you're carbon neutral, but you're not net zero. And in fact, the Science Based Targets Initiative has said you cannot claim a Paris-aligned pathway by 2050 if you are using more than 5 or 10% of your footprint reduction as offsets. Whole footprint, 1, 2, and 3.
Yes, thank you. So, yeah, if there are questions and criticisms, pressure that you would like to put on to the university, Melbourne Climate Futures is a doorway, where you can come to us, and we are very open to sort of working through many of these challenges that everybody is having to work through at the moment. But hopefully this panel has helped us sort of open the doors to some of the difficult decisions and challenges that corporate Australia is now dealing with. I'd very much like to thank the panel. Can we please have a hand for the panel?